When a parent is evaluating the assets of the potential subsidiary, certain intangible assets can be recognized separately from goodwill, even though they have not been recognized in the subsidiary's own statement of financial position. So the subsidiary had not recognized them, but the parent can recognize them. Which of the following is an example of an intangible asset of the subsidiary that may, so is an intangible asset of the subsidiary, intangible asset of the subsidiary that may be recognized separately from goodwill when preparing the consolidated financial statement. So we are saying the subsidiary had not recognized it as an intangible asset, but the parent.
Sorry, sir.
Yes?
I just missed the final part of the first question. My network was acting up.
Okay, so
yes.
For the first question, we concluded that the cost comprises of the transportation cost and the installation cost. Installation, dismantling cost, transportation cost, they are part of the cost. But the maintenance cost, that one is now an expense. And also the training cost is not part of the cost. Hello, Ezo, are you still there? Okay, let's move on. Which of the following is an example of an intangible asset of the subsidiary that may be recognized separately from goodwill when preparing consolidated financial statements? A new research project which the subsidiary has correctly expensed to profit and loss, but the directors of the parent have reliably assessed to have a substantial fair value. A global advertising campaign which was concluded in the previous financial year, from which benefits are expected to flow in the future. A contingent asset of the subsidiary from which the parent believes the benefits are possible. A customer list which the directors are enabled to verify reliably. So this one is more of is applying IAS 37. It's more of application of IAS 37 rather than the issue of subsidiary and parent or group accounting. So under which situations can we recognize an asset here? Maybe we can look at it from that point. Under which situations can we recognize an asset? If we have a customer list, yes, a customer list can be recognized as an asset, but provided that we can measure the benefit. So D is wrong because they are saying we are unable to ascertain the value of the customer's list. So D is not correct. C, a contingent asset of the subsidiary in which we believe the benefits are possible. For an asset, we only recognize an asset if the benefits are certain. If it's a contingent asset, it's an asset that we are expecting. We don't know whether we will receive it yet or not, but as long as we are not yet sure you will receive this asset, you can't recognize an asset. So again, C can't be recognized as an asset. A global advertising campaign, which was concluded in the previous year and from which benefits are expected to flow in the future. Let's hold that. A new research project, which the subsidiary has correctly expensed to the profit and loss, but the directors of the parent has reliably assessed to have a substantial fair value. I think A is the most ideal. So if we are looking at IAS 37, so if we are having a project that we are expecting to generate value, we conduct the research and we then develop that project. So the project which the research costs have been expensed, this one is likely to give rise to development costs, which the directors are saying they have a substantial fair value. So from IAS 37, research and development costs, the costs, if we are entering into development, we've conducted the research and now we have assessed that this can give us substantial benefits, then that one, it can be treated as an intangible asset. Advertising costs, those ones can't be an intangible asset. Those are expenses. But research, if a research has been conducted and now we are now in the development stage, the cost of that development can be treated as an intangible asset, of which the question was asking, which one can be accounted for as an intangible asset. So the cost of then developing the project, I think this one is the one that can qualify to be part of the intangible asset. So using the elimination method, A is the most ideal. Can check. So let's go with A for this one. So question number 3. For question 3, on 1 October 20X4, Flash Company acquired an item of plant under a 5-year lease agreement. The present value of the total lease payments was 25. The agreement had an implicit finance cost at 10% per annum, and the deposit of 2 million is required immediately, and annual rentals of 6 million paid on 30 September each year. Calculate the current liability of the lease in Flash Company's statement of financial position. So remember, the lease, when we did the lease, we said the current liability is the difference between the current closing balance and the next year's closing balance. But the closing balance that we take will be determined by whether the payment is in arrears or the payment is in advance. So we need what you call the amortization table. So I'm going to give you a hint. You are candidates, you are writing. I'm not going to give you everything in detail. So you're supposed to use your table. In this case, may I ask Hazel, is this payment in advance or is the payment in arrears?
I think it's in arrears.
Yes, the payment is being made in arrears. Why? Because the agreement is being done 1 October, but the 6 million is being paid 30 September each year. So the payment is being made in arrears. So the hint that I'm going to help with is the deposit. So the deposit is deducted from, so the present value of the total lease payments is 25 million. So from the 25 million, the opening balance, we remove the deposit. So the present value of the future payments, you are supposed to remove the payment which is supposed to be made now. So the deposit is paid now. So it means on your table, you start with 25 minus 2, which is 23 million. So that's the only hint that I'm going to give you. So if there is a payment which has to be paid now for the deposit, it reduces the present value of the future payment. So can you now work out the current liability? I'm giving you 3 minutes. Please, can you try so that you don't just, I don't just feed in answers to you. Can you attempt that? Quickly, I'll be checking the answers from each one of you. Okay, sorry, I'd gone out briefly. I hope you had not asked anything. So then hope you had not given out the answer yet. So if you are done, please just type your answer on the screen. Okay, from Terence, 4070. 4070. Hazel, now waiting for your answer. Hazel as well with 4.07 million. So from my calculation that I was also doing aside, I think we're in agreement. So let's move on. So I don't think we need to, or maybe, but those that have not joined, it's not our fault. So yes, this one is in arrears. So the difference between the current closing balance and the next year closing balance will give us the liability. So I think the closing, this year's closing balance, for me, that was 15.3 less the, it was, sorry, 19.3 less the 15.2. So giving us 4,070,000. So now let's move on. Question number 4. Financial statements represent transactions in words and numbers. To be useful, financial information must represent faithfully these transactions in terms of how they are reported. Only one of the following 4 statements regarding faithful representation is true. One statement is true. Identify that statement by clicking the relevant box. So, which one shows faithful representation? So, faithful representation, we are disclosing the true nature of the transactions. We are showing the true picture of what is taking place in the business. So from that, what can be classified as faithful representation? Let me try to drag the screen down. Okay, so charging the rental payments for an item of plant to profit and loss where the rental agreement meets the criteria for a right of use asset is an example of faithful representation, including a convertible loan note in equity on the basis of the holders are likely to choose the equity option on the conversion is an example of faithful representation. De-recognizing affected trade receivables sold without recourse is an example of a faithful representation. Treating redeemable preference shares as part of equity in the statement of financial position is an example of faithful representation. So faithful representation in this case is we are not overstating the nature of these transactions. We don't want to show a false picture where the company is doing well while it is not. Because in most cases, faithful representation is applied where we've not window dressed the accounts. And window dressing the accounts is normally a situation where you want to show a good picture while the company is not in that direction. So maybe let me help with this one. From the answers, I think C is the most ideal. Why? If we feel we de-recognize in the event that the receivables, sorry, let me read again, de-recognizing factored trade receivables sold without recourse. So we sold the receivables. So if we have factored the receivables, it's no longer money that we are expecting. We can't keep recognizing it. Otherwise, we would overstate what we are expecting to receive. So we should de-recognize. Once the receivables, we're not expecting to receive anything, we should de-recognize that. So if it's faithful representation, we are not overstating what the company is expecting to receive. So if we have factored the receivables, we have sold our receivables. On 1 October 20X4, Kalantra Company commenced drilling for oil from an undersea oil field. Kalantra Company is required to dismantle the drilling equipment at the end of its its 5-year license. It has estimated the cost of 30 million on 30 September 20X9. Kalantra Company's cost of capital is 8%, and dollar in 5 years' time is a present value of 0.68. What is the provision which Kalantra Company would report in the statement of financial position as at 30 September 20X5 in respect of its oil operations. So which year is this? We are in. So we the hint that I'm going to give you, take note. We are 1 October 20X4. The dismantling cost is expected to take place after 5 years. We are told the cost is 30 million, 30 September 20X9. But the question is asking 30 September 20X5. Meaning what? This is at the end of the first year. So can you try that? What provision for dismantling costs should we show in the statement of financial position? So initially, the cost of the asset or the cost of the license should include the provision for dismantling cost at their present value. Then at the end of the year, we increase that provision. But if I go any further than that, I'll be telling you the answer. Can you try that and type out your answer? Sorry, can you type again your answer? I wasn't looking at the screen. Okay, Ezo said B. Terence said 162.32. So we have a B and D. So it's now interesting. Let's get to C. Which one? B and D. Okay, so initially, an asset, you recognize the asset at cost. If it's the license, you recognize it at the cost of the license fees plus any dismantling cost. So the question though is just focusing on the dismantling cost. So initial recognition. So for the initial recognition, you're saying the 30 million times the discounting factor. So the 30 million times the discounting factor, what do you get? If we say 30 million, so the 30 million, the present value of that 30 million, it would be 30 million times, it would be 30 million times 0.68. So that's 30 times 0.68, which is 20,400,000 or 20.4 million. That's on the date. That's on initial recognition. Then this provision, it means today is 20.4. But when we make the payment after 5 years, the amount will be 30 million. So every year we increase that provision by the cost of capital. So we can look at increase in provision. This one, we take it to profit and loss, that increment as an expense. So the increment would be, you take the 20.4, you multiply it with the cost of capital. So the 20.4, it's called unwinding the discount. So it means you all had an idea, because I'm getting 632 as well. But I think the question is what you did not. Who is that? I think Terence. You missed the question there. Shows you're in the right direction, but you missed the question there. Why? Because the provision is increased by 1.632. So the question now the question was saying, what is the provision? If the question had asked how much should we take to the profit and loss, is the 1.632. But the amount we take to the new provision, the question is saying, what is the provision? It has increased from 20.4. What is now the provision? So you need to add now. So the 20.4 plus 20 plus 1.632, it would be 22.032. So I think you were close. It's just a matter of understanding what they are saying here. Because what is the provision to be reported in the statement of financial position at 30 September? So if they had asked for the amount to report as an expense, you would take that 1.632, or if they had asked for the increase, but they are saying, what is the provision? So if it was at 20.4, now it is increased by 1.6. The new figure becomes correct. Let's move on. Question number 6. When a single entity makes purchases or sales in foreign currency, it would be necessary to translate the transactions into functional currency before the transactions can be included in its financial records. So, in accordance with IAS 21, the effect of changes in foreign currency exchange rates, which two of the following foreign exchange rates may be used to translate purchases and sales. Purchases and sales, if these ones have been taking place throughout the year, we use an average rate. So for this one, if it has been taking place throughout the year, we are going to then use the average rate. So this one is there as part of the answers. Then they are saying 2. So an average rate, provided that there are no significant fluctuations through the year. So since these are items of the income statement, you can use the average rate if the purchases have taken place maybe throughout the year. The other issue is the rate that existed on the day of the purchase, the rate that existed at the beginning. We can't use the rate at the beginning of the year. It should be either the rate at the date per data transaction. Let's say Tangoita my purchases are once, we can use the rate on the date of the transaction. But if the purchases have been taking place throughout the year, we can use the average rate. So I think the two answers that can suit here is this one. the rate on the date of the transaction or the average rate. So the rate at the date of the transaction, this is provided that the purchases or the sales have maybe taken place once. Then if they've been occurring regularly, we can use the average rate. On 1 October 20X4, Roy Company had 2.5 million of equity share capital in issue.
Sorry, sir.
Yes.
I have a question on the previous question.
Yes.
I didn't get why we said the rate on the day of the purchase and sell is incorrect.
So why I said what?
Sorry, question Iguda 1 kana 2.
Iguda 2.
Okay, all right.
So I picked the average rate. So basing on the fact that if the kana mapurchases aitaka maitaka kawanda, tinongogona the average. But kana takangozviita once, we can use the rate on the date of the transaction. So I picked the first and the.
All right, it's okay.
Then also in the exam, if it's a box, question I would wish to. But if it's a box, it's multiple answers. If it's a circle, it's just one answer. So, but on what about my box, you go after the question again. Normally to my box, it waits for multiple answers.
Okay, thank you.
So you can read question 7. You can read question 7. So on 1 October 20X4, H company, let me leave you to quickly read that. Okay, so the question is on share options. Share options, this is just a right that we give to our employees in most cases to buy shares at a certain price in future. So for the share options, we can give the employees a right to buy the shares at, let's say, 20 cents, regardless of whether the share price is going to rise or not. So they will buy the shares at an agreed price. So it's just a way of rewarding them. You can say after they've worked for 10 years or 5 years, they can buy the shares at a certain price. So it tends to be a benefit to, it's a way of just layering the workers so that they can keep working at that company. So if they choose to convert their shares, that if they choose to buy the shares, in fact, we don't save any interest. Unlike for convertible instruments where we save interest, here it's not saving any interest, it's just increasing the shares. So the question is saying, of course, it wanted you to click, but instead of clicking, just calculate the diluted earnings per share. Yes, let's just do that one. Let's try to calculate the diluted earnings per share. It's just the earnings per share factoring into the shares that can arise if the employees are to convert their options into shares. Can you try that? So unlike convertible instrument, this one doesn't affect the earnings because we are not saving any interest here. Let's quickly try that. I think it's time up because this one is not that long. Let me help. Or have you tried anything, Terence? Yes, so I can't see her in. Have you tried? Oh, Avar.
I said,
Yes.
yeah, thinking that if I were.
Okay, it's just so it's just earnings over number of shares. The only tricky ripo apa or the paigona ngo trust say mbijana pakutsvaga ma shares. So my earnings here it's still let me slash the zero. It's that's 1.55. Okay, so those are our earnings. Then we divide that by the number of shares. So the number of shares, we have 1.2 million. If we slash zeros, 1.2 million, these are the potential shares. Kana vakanzi ivo vaconverter kana kuti vatenga these options. Dilutive, kana ichasa diluted earnings per share, tiri kuti kana vanhu vakazonzi vane mashares zvinoaffecta sei ma-earnings per share. So pese patinotsvaga diluted earnings per share, kana iri convertible instrument, tiri kuti kana vakanzi vaconverter mashares anoita mangani. Apa tiri kuti kana vakanzi vazotenga ma-options mashares anenge amangani. Saka apa anobva awedzera ne1.2 million, but anenge ari mangani mashares. Mashares haasi 2.5 ka. 2.5 imari, ivalue yemashares. and each share ndere 50 cents. So it means my shares edu ngochiti 2.5 divided by 50 cents, which is 5 million. So ndoba paine ka trick pakuti vazhinji aigona kubva angonoedera 2.5 plus 1.2 million. So kuti tiwane our earnings per share apa, our diluted earnings per share, edera ma shares ayo ekuti vakaconverta ma options ayo into shares, tinoita ane ma shares mangani, but take into account kuti 2.5 is given as the value, not the number of shares.
Okay.
Okay, we have question 8. Can you try question 8? The first question. You don't get in a multiple, does it? Okay, it's just question 8. Can you try question 8?
Okay.
Hello, we are now looking at question 8. Can you try question 8? I noticed you missed question 7. So for question 7, tazongoti isusu. For question 7, tati isusu. My earnings data has kuchinja. So my options are anowedzera my shares. Anodilute kana akanzi iye a convert ani ma options ani ma shares achanowedzera ma shares atinawo. So ma shares atinawo unoti iwewe atinawo anzi nde value 2.5 each richiita 50 cents. So it means currently tine 2.5 divided by 50 cents towana ma shares atinawo, then plus aya ekuti tikadiluta tikanzi tachinja ma options into shares anopiwa 1.2. So we'll add those, what will my earnings divided by that, then you get your diluted earnings per share. Now let's try question 8 quickly. Are you winning or you have surrendered? Terence is down. Yes, though?
Still trying, but I don't think I'm winning.
For the sake of time, let's quickly do it together. So calculate the profit or loss on disposal before tax. That would be recorded in the consolidated statement of profit or loss. Okay, Folk owns 80% of investment in Spoon. So Spoon is the subsidiary, which it purchased several years ago. The goodwill on acquisition was valued at that, and there has not been any impairment on the goodwill. So it means the value of goodwill is still the same. If there has not been impairment, it means goodwill is still the same. Since that date of acquisition, on 30 September, Folk disposed its entire investment in Spoon, and details which are as follows. So we sold for 5,580. Isuzu Tatatenga the investment at 3.720. This is the cost of the investment. Tatatenga the investment at 3.720. We sold at 5.580. Immediately before the disposal, we are told the carrying amount of the net assets were 4.4. The carrying amount of NCI was 900. So if we are working out, if you are calculating the profit on or loss on disposal, the 2 years. So if you're calculating the profit or loss on disposal, it's just the same issue. We say the sale proceed minus the fair value of subs net assets less NCI. So we are saying Takatenge some assets at this price. But my assets it included the assets that also belong to NCI. So you say from the price you sold, you less the fair value of the assets and the value of NCI. So we are saying in this case, we sold at, we can say the sale proceed. We sold at 5,580. And what were we selling? The fair value of the net assets, fair value of sub. What was the value of the assets in the subsidiary? So the value of the assets in subsidiary, we are told the other net assets were amounting to 4,464, plus the goodwill was also part of the assets and it had not changed the value. It was 1,6 something like that. Let's check. $1,674. So this is the value of the business. We sold it at 5,580,000. But the value of the business the value of the business as a whole is 4464 plus 1674. The value of the business is 6138. But from that value, there is the portion which does not belong to us. So let's remove the portion which is not ours. We remove or rather, firstly, how much is our profit? So it means we are going to deduct that. Then let me read through the statement. The carrying amount of non-controlling interest. So the carrying amount of net assets is that. So it means we sold at 5580. The assets of the subsidiary, the fair value of net assets of the subsidiary, it was that. In fact, no, the NCI is supposed to be added, not subtracted, because we are saying the portion of the assets that we had recorded, because in the books we have recorded the assets of that 6,138, but part of that we have NCI. So the NCI, let me work it out and see if it makes sense there. So it means this becomes the profit or loss. If it's positive, it's profit. If it's negative, it's a loss. Let me first work out that and see if it, so that's 5580 plus 900 minus 6138. $55.80 plus 900 minus 6138. That's 342. Oh, by the way, this one, it was not having answers. Okay, we just verify this one. We verify, let's verify this with the answers, but because the NCI, got the sale proceed, we sold at 55.80, and the portion that did not belong to us amounted to 900. Then overall, the assets, you subtract that to get 342. Okay, let's verify this with the answers. I need to confirm the NCI part there. That's question number 8. Question 5, we're correct. Question 7, or question 8, 342. Okay, so just take it down. So the profit on disposal, We say the sale proceed, we add the NCI, we less the value of the assets on the date of disposal. So to get the profit or loss on disposal, it's the sale proceed, we add the NCI less the value of the net assets of subsidiary on the date of disposal. So let's look at question number 9. Consolidated financial statements are presented on the basis that the company are treated as if they're a single economic entity. Which two of the following are the requirements of preparing consolidated financial statements? When you are preparing consolidated financial statements, take note of Zandataura, if there is a box, there is more than one. So which two? So they're saying which two? Which two of the following are requirements when preparing consolidated financial statements? All subsidiaries must adopt the accounting policies of the parent. Subsidiaries with activities which are substantially different to the activities of other members of the group should not be consolidated. No, they like this question, and this one is a wrong statement. I've seen this in a number of questions. So we don't stop consolidating because my activities are Asian. The consolidation is based on control. As long as we are in control, we consolidate. We consolidate based on control, not based on the activities we are carrying out. All entity financial statements within a group should normally be prepared to the same accounting year prior to consolidation. All entity financial statements within a group should normally be prepared to the same accounting year prior to consolidation. Yes, so for us to consolidate, the date, the financial statement date, read the same date. So we should be preparing my accounts on the up to the same like we now need to have the same financial year because we need to add the accounts of the parent and the subsidiary. So we must now have the same accounting year. Unrealized profits within the group must be eliminated from consolidated financial statements. Yes, we remove unrealized profit. We don't recognize profit when we sell between the parent and subsidiaries. So unrealized profit should be eliminated. The first one was saying all subsidiaries must adopt the accounting policies of the parent in the individual financial statements. No, they can still go ahead applying their policies, but we consolidate. So we can buy the business. Business irorotoramba rine management yaro yarari nayo. Tisu tingone control, votoramba vachirana how they were running the business, but we consolidate it. So it's not a must. So the term must there, yes, we can change, but it's not a must. They can go ahead with their policies. So the last two, I think they are ideal. A parent sells goods to 80% as a parent sells goods to its 80% owned subsidiary during the year, some of which remains in inventory at the end of the year. Match the tokens to the appropriate item in the statement of financial position to reflect the adjustment required in the consolidated statement of financial position to eliminate unrealized profit. You can read that statement on your own as well so that you understand it better. Match the token to the appropriate item in the statement of financial position to reflect the adjustment. Required in the consolidated statement of financial position to eliminate any unrealized profit. This question is a bit tricky. I'm failing to articulate what's the requirement here. They're saying match the tokens to the appropriate item in the statement of financial position to reflect the adjustment required in the consolidated statement of financial position to eliminate unrealized profit. So I want to eliminate unrealized profit. Okay, I think now I get it. So the issue is we want to eliminate unrealized profit. We want to eliminate unrealized profit. So what adjustment should we do? Remember to subtract from profit, because when you're calculating group retained profit, you remove unrealized profit. So we're supposed to remove PAP. So if you are removing from retained earnings, you debit. To subtract from retained profit, we debit. Then non-controlling interest. Non-controlling interest, do we account for unrealized profit? No adjustment. In inventory, so non-controlling interest, no adjustment. Then inventory, you subtract. PAP is removed from inventory. So if you are subtracting from inventory, it's an asset. You credit inventory. So to subtract from inventory, which is an asset, you credit. So I think, yeah, those are the matchings. So they are saying we want to adjust for unrealized profit. How will this be adjusted? When you're calculating group retained earnings, you subtract. Subtracting from profit, it means you're debiting. Subtracting from inventory, it means you are crediting inventory. Then in NCI, we don't adjust them. Question number 11. Let's look at question 11. Question number 11. Can you quickly try, please? Hazel thinks it's A. Terry, we are waiting for your thought as well. Terry is going for A. Let's check. Let's confirm. On the assumption that is an associate, what would be the carrying amount in the investment? For an associate, we equity account the investment in associate. So for equity accounting, you initially recognize the investment at cost. So initially recognize the investment at cost. That's you bought 240,000 times $6 per share. So 240 times 6, that's then we move on to, if it's equity account, you start by recording the investment at cost. Then if you make profits, the portion of profit, it increases the value of your investment. So the share of profit. So how much profit was made by the subsidiary? So the profit is 400,000. And what's our share? Our share of that profit depends on the shares that we have. So if we bought 240 out of 800, that's 240 divided by 800. We bought 30%. So 30% is the share of profit. 30% of 400 is 120,000. Then, so if you make profits, they increase your investment. But if you receive dividends, they are actually taking the dividends from the profit. So the dividends you receive are reducing the profit. They are reducing the earnings. So with less dividends received. So you made an investment. The investment gains if you make a profit. But if you take a dividend, it reduces that investment. So with then less, it paid a dividend of 150. So the 150 is not the dividend you received, it's the dividend which the company paid. So since we are being paid 30%, so 150 is the dividend in total, our 30% is 45. So 144 plus 120 minus 45. Okay, I think yes. A is the answer, 1515. So A is the answer. Let's move on. Question 12. Can you read through question 12 and tell me what you think? So I want to compare the two companies. What can be said to be, we can't use this one as the basis for comparison. What can we use to rule out the basis as the basis for comparison? That no, this one we can't compare based on this. So what can we rule out as the basis for comparison? So for the basis of comparison, what can we rule out? So I think the first one is saying the current year, the quarter has experienced significant rise in costs for its purchases. So if it's your company that is, sorry, the quarter is in the jewelry industry, and which can be let's look at the second one, maybe let's see. The sector average figures are compiled. So we're comparing based on what? By comparing basing on the sector average. We are comparing based on the sector average. So if it's the sector average, if it's that sector, then if your costs are higher than the sector average, then that one, it can be a basis for comparison because it's the same sector. It would be a problem if it was different sectors where we would say, maybe my cost attributed department in our sector are higher. So for the first one here, I don't think we can't debate to say the basis of comparison was inappropriate because my cost a company either too high. Why were they too high? Because it's the same sector. The second one, the sector average figures are compiled from companies whose year end are between 1 July 20X5 and 30 September. I think, yes, this one, IT. Because Isuzu, we can't be assessed because for quarter company, for the year, to go access yearly information. So we can't say for quartile company, to figures for the year. Then the sector, the information is from 1 July to 30 September. So the comparison period should be the same. We can't be comparing 6 months period against performance because if there are seasonal factors that can distort the performance. So it must be the same period. So the second one here is out. Quartile company does not revalue its properties, but is aware that other entities in the sector do. So does not revalue, but is aware that other entities do revalue. So we can't compare again, I think, on this basis, because it means our accounting policy is different. We should have the same accounting policies. Let's see maybe the last one. During the year, discovered an error relating to inventory count on 30 September. This error was correctly accounted for in the financial statements for the current year. So if you discover an error, we can't say you can't compare because I've discovered an error. No, that one I don't think. So the correct answers, I think the second one and the third one. We need to compare if we are using the same basis and the same period. So if the period is different, then the basis of comparison is not appropriate. And also if the policies are different. Because if we are using the revaluation model and the other entity is not using the revaluation model, then comparing might not be ideal because our figures will be affected by the model we are using. So I would think those two. Which of the following criticisms does not apply to historical cost financial statements during a period of rising prices? So if it's historical cost, we are recording our balances at their historical values. We are recording at historical values. I think there's a statement I gave in the last session. So which of the following criticisms does not apply to historical cost financial statement during a period of rising prices? They contain mixed values. Some items are at current values and some are out of date values. They are difficult. Which criticisms does not apply to historical cost? They are difficult to verify because transactions could have happened many years ago. They understate assets and overstate profits. They overstate gearing in the financial position. So which one is not a criticism? Yes, in terms of rising prices, Karama prices are assets price they are understated. So yes, historical cost where we are recording my assets at their historical value, they are likely to be understated because value in as prices rise. They overstate gearing in the financials. They overstate gearing. Yes, the gearing will be overstated because our assets figure in Oramba pass, of which the assets, the net assets will determine the amount of gearing. So if our net assets are not increasing, it means our gearing will start rising. So which one is not an appropriate criticism? They contain mixed values. Some items are at current value and some are out of date values. Yes, under the historical cost, my assets nanga report at historical values. So I think the second one, you can't argue to say historical costs are difficult to are difficult to determine because we don't determine them panopera gore, but tinotogara tatorecorda at historical value. So it's not like it's a value that we will need to determine each year. Once the transactions have been recorded at their historical values, we're not going to be changing that. So the amounts are not determined each year. So that one is not a realistic criticism. But Mamu Ayo, there are arguments that can hold water. So I would go for the second. The theory questions, they're a bit tricky because they require you to have knowledge part. You need to, this is where you need to read the notes to have an idea of the concept. Question 14. The following information has been taken or calculated from Flower Company's financial statement for the year ended 30 September. Complete the following table by dragging and dropping the tokens into the appropriate place in order to reflect the correct calculation for Flower Company's cash cycle at 30 September. Can you try question 14? So I think it's about calculating the inventory turnover days, the receivable collection days, and the trade payable days. So we have 42, 51, and 61. So you have to calculate those days and see which one goes to which one. Also, our inventory turnover days. So for inventory turnover days, we are told that the inventory turnover is 6 times. So the rate of inventory turnover, inventory turnover is 6 times. The year that we use in a 365 days. So if the inventory turnover is 6 times, if you can divide that by 365, it will give us the days. It means inventory turnover, it means in a year, we replace the inventory 6 times. So how many days do we take with the inventory? If we are going to replace it 6 times, in a year that is 365 days, you say 365 divided by 6. What's 365 divided by 6? Hello, what's 365 divided by 6?
60.8, which is 61.
61. So do we have 61 there? So 61 is for the inventory turnover days. Then the receivable collection. So the receivable collection, what are we given for receivables? We are given payables, cost of sales for 30 September. So the receivable days, our formula says that's receivables over sales times receivables over sales times 365. So we don't have the sales, we don't have the receivables. What can we use there? Is it the receivable days? Okay. For receivable days is a bit tricky. Let's check the payable days. Payable days, to the trade payables, we are given the trade payables 230. So for payable days, it's 230 over cost of sales times 365. So we have the credit purchases. So we say over the credit purchases. If we are given credit purchases, you can say over credit purchases. So it's the receivables over credit purchases times 365. That's for the payable days. Then for the receivable days, can we work out the sales here? We are given the cost of sales. What can we do here? Oh, they've given us the cash cycle. So if you say the inventory days plus the receivable days plus the payable minus the payable days, you get the cash cycle. So because you're not given any sales, or receivables here. So if you add the inventory days, receivable days, less the payable days, you should get the cash cycle. So I think this one will be used as a balancing figure. So once we have the inventory days, the payable days, can calculate B as our balancing figure. Let's try question 15. NCI. Fair value of NCI. That reporting there. Let's quickly try that, please. So due to our time, let's do that together. So we have 9 million shares. We have 9 million shares times, if we bought 80%, it means 20% is NCI. So this will tell us the shares for NCI times, each share is said to be of 350. So the NCI value of NCI shares, that's 9 million times 20% times 350. So fair value of NCI on the date of acquisition, NCI was 6.3. But, so we have zero, so that's 6.3 million. Then the NCI gets a share of post-acquisition profit. So share of profit for NCI, we are told after acquisition, the subsidiary made a profit of 8 million. Then we are told that at the date of acquisition, Pabine plant which had a fair value of 3 million more than the carrying amount. So my assets are with zero value in 3 million. The increase here, depreciation for the fair value adjustment, no register profit. Zero out my assets, my record than 3 million. Akaitwa understate 3 million. So kuwedzera kwatinoita value yama assets, kunowedzerawo depreciation. So kunono register the profit. So the assets achanowedzerwa 3 million, depreciation ichanowedzerwa and the remaining useful life of 5 years. So it's 3 million divided by 5. So it means the depreciation ichanowedzera 600,000, but that would be for the year. So this is October. Yes, it's at the start of the year. Acquisition at the start of the year. So by the end of the year, depreciation year, depreciation year 600, which is 3 million divided by 5 years. So that extra depreciation in honor register profit times the 20%. So this one is the share of profit for the NCI. $7.4 times 20%. It's 1480. So overall, the fair value of NCI at the end of the year is 7780. So that's there, 7780. Okay, so that was our section 8. So your task that I want you to go and do, go and attempt the pre-mock, like I said. For today, let's end